Blackstone property fund targeting small investors passes $50 billion. Fund known as BREIT has scooped up rental properties, warehouses, office buildings. If you are not familiar with Blackstone, it is one of the largest institutional investors, corporate landlords, if you will. Blackstone was the first ever institutional investor to begin expanding a portfolio of single-family homes for the purposes of renting them out and created a securitization market for single-family rental units. They eventually got out of the game in 2019 just to get back into the game whenever there was an opportunity to see a group of otherwise interested home buyers not be able to enter the home buyers market due to the economic related downfall tied to COVID-19's recession. And so they are back into the single family industry, purchasing as many homes as possible through these mergers, or rather acquisitions. So from there, they are full force doing exactly what they began in 2012, 2013. This time, they have a little bit of a different approach with investing in affordable homes, as well as some other major acquisitions that will offer a new kind of opportunity for first-time homebuyers to be able to potentially own a home one day through this new endeavor that Blackstone is offering. So, the largest fund administered by Blackstone Group, the giant investment firm known for raising capital from institutions such as pension funds and endowments, is now one of the mostly targeted individual investors. Blackstone Real Estate Income Trust, a fund sold in increments as little as $2,500, has raised more than $50 billion since it started 5 years ago. The firm has used the fund known as BREIT to buy rental apartment buildings, warehouses, office buildings, casinos, and other property types. Like other funds structured as non-traded real estate investment trusts, BREIT experienced a decline in fundraising in the early months of COVID-19 pandemic, but by mid-2020, the pace had picked back up. Last year, BREIT raised an average of more than $2 billion a month, or close to 70% shares of all money invested in 2021 in non-traded REITs. This exceeded even our own lofty expectations, says Jonathan Gray, Blackstone's president and chief operating officer. Warehouses, including one in Northern California, are among the acquisitions made by the Real Estate Investment Income Trust. So if you're not familiar with what a REIT is, a real estate investment trust is a investment opportunity usually offered by private equity firms, where if you are an investor who does not want to outright own a property, you may invest in a company that has real estate, and as a shareholder of those properties, you will receive a return on your investment based on the revenues generated from the investment property owned by another corporate entity or private equity fund. It's just another way to invest in real estate to receive some sort of return that doesn't necessarily require you to actually purchase an entire investment property yourself. BREIT has lured investors partly by paying them an annual yield of 4 to 5%, far more than corporate and government bonds in recent years. Also, BREIT has loaded up on the properties that have enjoyed rising values in recent years, such as warehouses and rental apartments, even as the pandemic has raged. The combination of yield and rising property value produced an average annual return of 15.2% for the 3 years that ended December 31st. This is according to Robert A. Stranger and Company, an investment banking firm that tracks the non-traded REIT market. Blackstone's ability to maintain such performance in both fundraising and investor return will face new challenges in the coming years. Analysts doubt that residential and industrial property will be able to sustain their recent trade of price increases, especially if rising interest rates makes bonds more attractive compared with real estate. We'll see if that happens. Based on what we are hearing from our nemesis, Ken McElroy, real estate's booming. Now's the time. Get into the real estate market. And often these real estate gurus are talking about the alternative to investing in property yourself, and that is through investing in a REIT. It sounds like Blackstone's REIT in particular is doing quite well. Now, perhaps one of the reasons why this REIT is doing so well is because Blackstone sees the opportunity to increase revenue shares per investment. And that might change if there is a shift to maybe moving to a bond investment, if there is a higher return on those types of bonds. But I don't think that based on institutional investors' propensity to corner the real estate market, specifically the single-family homes market that is generating more rental properties, this endeavor is going to go anywhere anytime soon, but there might be a slight shift away to another form of investment later on. Who really knows? Who are we? Real estate speculators? Speculators in general? Meanwhile, Blackstone faces new competition in the fundraising world from investment firms, hoping to mimic REIT's success in tapping into smaller investors. Newcomers to the non-traded REIT business last year included Brookfield Asset Management, Inc. and KKR and Company. You would think over time the market would spread out, said Kevin Gannon, Stranger's chief executive. Well, I think in terms of the major players in the rental housing market, they have been able to corner the market enough and monopolize the industry that it might make it difficult for competitors to even get there into the market based on how well they have worked to acquire these properties over the last 10 or so years. Not to say that this is a good thing. We should not have institutional investors vying after vacant properties the way that we do, but it could also be the reason why Blackstone, BlackRock, some of those other major investment companies on Wall Street have been able to take the market share of available properties to expand their ever-increasing portfolios, especially in the single-family rentals market. So BREIT last year joined other Blackstone investment vehicles in buying data center owners QTS Realty Trust in a deal that valued the company at roughly $10 billion. The fund also joined a partnership that last year purchased the real estate assets of the Las Vegas Cosmopolitan Casino and Hotel in Las Vegas. They really are expanding their investment portfolio. Holy shit. We expanded what we do in BREIT, said Mr. Gray, who led Blackstone's real estate business until he was promoted to the firm's president in 2018. Blackstone executives also expect the BREIT to perform well in an inflationary environment. They point out the properties, such as the warehouses and rental apartments, have leases that are reset every few years, which enables them to keep pace or stay ahead of rising prices. Well, how do they do that? Well, easy. They are not shameless in their price gouging, all right? This is how they got their major pet project off of the ground, Invitation Homes, by using the deregulated power that they had over their portfolio of single-family homes to adjust the cost of rent upward based on the appraisals that were conducted by not by non-appraisals, if you will, because with SEC regulations that they must abide by, they don't actually have to have a licensed appraiser. They can hire a third-party consultant who, according to reports that came from other major outlets, those third-party consultants only appraised the value of the home's exterior, which meant that they were only looking at the facade of the home, and they were told by Invitation Homes to assume that all interiors of those homes looked like the interiors on the website, which inflated the overall value of the single-family dwelling that allowed Blackstone's Invitation Homes to set rents at a much higher price, right? All of these tricks are used by Invitation Homes and other institutional investors to find ways to legally price gouge their homes and charge higher rents. If you have a 30-year fixed rate lease, that is not what you want in an inflationary environment, said Frank Cohen, chief executive of REITs. Non-traded REITs have been around for decades. They fell from favor among investors and financial advisors before Blackstone got involved in the business because they charged high fees and attracted regulatory scrutiny over disclosure issues. Blackstone addressed these concerns with BREIT, which was structured differently from earlier non-traded REITs. There is more disclosure and fees, more aligned with fund performance. If we don't generate strong returns, we don't get paid as much, Mr. Cohen said. Well, that's true. If we don't generate strong returns, we don't get paid as much. So we have to find any means necessary to increase the cost of rent that we charge for our newly owned properties, like casinos and warehouses that are probably, in terms of economic output that is generated during a heightened time of the coronavirus pandemic, is not generating as much revenue. But again, these are long-term investments that could have the potential to make Blackstone a lot of money if our economy ever gets up and running full swing. I guess only time will tell. Blackstone always seems to land on their feet. I don't doubt their own means of finding a way to capitalize off of these acquisitions in some way that will obviously burden the tenants who must pay a monthly rate to temporarily occupy these spaces. Blackstone's done it before. They're going to do it again. The means from which they do so, that's yet to be determined.